Good morning, everyone, and thank you very much for joining me. This is the morning market review with myself, Russell Shaw. I'm a senior market specialist at FXCM, and my email address rshaw@fxcm.com. Today is Wednesday, the 31st of May. I'm just going to go ahead, bring up our disclaimers. We'll start off with the high risk investment warning. I'll keep this on screen for a few moments. All right, and let's go ahead and bring up the market commentaries disclaimer. All right, and our references. We've got a live trade on Friday. It will be the non-farm payroll live trade on a live account, and what I'm going to do is just get the link and paste that into the chat. And if anybody wants to join us for that, you're certainly most welcome. All right, I've put that into the chat. If you don't get it, just let me know. I'll send it through to you as well. Hey, Howard, morning to you. Nice to have you on the webinar as always. I've just sent the link to everyone again, just in case. All right, I want to just do a few things today. First of all, just to finish off the analysis on the Russell 2000s. Something that I saw yesterday, which I think is interesting. I want to show you guys. And then we started last week looking at the triple moving average. I was meant to just complete that on Friday, but then we had technical issues on Friday. So we'll just we'll combine the triple moving average with the analysis of the Russell. I wanted to show you guys what's happened with the Russell 2000. The Russell 2000, we call it US 2000 as our instrument. It's effectively a small companies index. Yesterday we saw that it's lagging, and what we want to do is, hey Andrew, morning to you. Nice to have you on the webinar as always. Thank you for joining. The idea behind the Russell is that it tends to lead markets. So the fact that it's not participating in strength is a concern. It's worrying, because we looked at long-term investment analysis yesterday. We looked at the monthly COPOC. We went down to the peak and trough analysis of the weekly, and by and large, most instruments, most risk-on instruments, were looking pretty good. But the Russell was lagging, and what you can see on the screen here, the top chart is our US 2000. The bottom chart is actually the SPX 500, and you can see that there is parallel movement here. When I say parallel, similar movement prior to March. So you've got a trough here. You've got your peak here on the Russell. Go down to the SPX. You've got same thing happening. You've got a reference trough here, and you've got a reference peak here. So far they are in sync. Okay. As we continue along, you can see that in December we got the higher trough for the Russell. At the same time, we got the higher trough for the SPX. Okay, and then the next wave gives us the higher peak. So Russell now moves into uptrend here, and SPX moves into uptrend here. All right, and everything's looking pretty good at this stage. But then what happens is we get a big sell down in March. There's the sell down in the US 2000. There's the sell down in the SPX. And now it gets really interesting, because what happens is the US 2000, let's just, this So the US 2000 remains subdued, whereas the SPX makes recovery. So let's just write that in. No recovery. No recovery, right? Recovery. So the question is, what happened? What happened in March? What happened in March that led to the sell downs here? Can you guys remember what happened in March that led to the sell downs here? And we don't have to look that far. It was effectively the failure of the three banks, right? Silvergate, Signature Bank, Silicon Valley Bank. There was this banking crisis of confidence, and we get a huge sell down in the markets. What subsequently happens is SPX 500 manages to recover, and the Russell 2000 doesn't. Why? Why is the SPX 500 showing recovery, and why is the US 2000 not showing recovery? Okay, and it is because of the banks component. Okay, it's because of the banks not tighter lending per se. It's because of the banks component within the index. The Russell 2000 has a serious weighting of banks. Take a look at this. Let's take SPX 500 out, or let's leave it in. Sorry, let's leave it in, and let's add in the US banks index underneath that, the US banks basket, I beg your pardon. So we'll use FXCM's US banks basket as a proxy for banks. Okay, and let's pop this a little higher up. And now take a look at the peaks and troughs. So you've got a trough. Okay, it's almost a mirror image of what's going on with Russell. Trough, peak, right? Here's the higher trough. Okay, here's the higher peak. Here's the sell down. There's the sell down. And what we can do is we can put this trend line in like this. And what we can do is we can write in no recovery. Can you guys see that? It's almost like a mirror image. So effectively, if we want to see the Russell starting to show leadership, there has to be a recovery in the banking sector. You get that recovery in the banking sector, you're going to start seeing the smaller company index starting to perform. So that has, I think, serious fundamental implications, right? If we want to see our bull market, as per our study yesterday, really carry on. If we want a bull market with legs, well, we have to look at the US banks, and we have to see if the US banks sector is going to show signs of recovery. How can we do that? Well, one way we can do it, it's not the only way, one way we can do that is with our triple moving average system. So the triple moving average system, I want to show you the settings that Dawn Bolton Smith used to use. I said I'll check that up for you, and I have. And she uses the 5-15-30. Okay, she uses the 5-15-30, and I believe she used the exponential. So let's throw in some exponential moving averages here. Let's put it into the Russell first. So let's add in 3 moving averages, right? And what we're going to do is we're going to change the first one to the 5. We'll make that one green. Okay, the second one we'll make 15. We'll make that orange. And we can put in the 30. We'll make this one red. All right. So you can see we can use the three moving averages, the triple moving average, to see if there is some sort of recovery in the US 2000 or the banks. Let's add in the three moving averages onto US banks and onto the SPX 500 just to take a look at the signals of the system. So let's add in three moving averages here. We're going to make the exponential 1, 2, 3. And let's put in the settings. Green 5, orange 15, right? And then the red 30. All right. And last but not least, let's do it with the SPX 500. Okay. Add indicators, exponential moving average, 1, 2, 3. Five green. $15 orange. And for our third one here, we're just going to make this one red 30. And now you can see the difference. Let's take a look at the moving averages, and we can see the stark difference between the Russell 2000 and the SPX. Take a look at the SPX. SPX has the green on top of the orange on top of the red. Okay, the signal is generally intermediate over long as the long entry. I'm looking for the ellipse. Okay, here is the signal there. Here we don't even have the any of the crossovers that we need over here. See that? Let's just okay. No crossovers. No crossovers. Here's we've got. So here we're in. When I say here, the SPX 500 is in bullish mode. Green on top of orange, orange on top of red. The US 2000s on bearish mode, green below orange, orange below red. Take a look at the US banks. The US banks showing some signs of recovery. Now this is important. This is where we can start watching. What we want to do is we want to see if we can get at least a green on top of orange. If we get a green on top of orange, that would, in my opinion, be a tailwind for the US 2000. The US 2000 would start benefiting perhaps from US banking support. Then we want to see the US banking orange move on top of the red. Well, once we've got that, then potentially the Russell 2000 starts to show signs of strength. Now, there is a chance that this happens. There is a chance this happens. How come? Why am I saying there's a chance this happens? Because if we go back to the, let's make this instead of US 2000, I'm just going to use the code RUT, which is because there's more history with the Russell 2000, right? I'll use the trading view instrument. It's exactly the same chart. What I'm going to show you is the monthly COPOC. This is what we looked at yesterday, right? The monthly COPOC. Let's just bring that in. And you can see that the monthly COPOC, okay, has turned up. It's turned up from below zero. Okay, so the fact that it's turned up from below zero, well, that in of itself, I want to make this zero, that in of itself is a long-term bullish signal. What do we need from the weekly chart? We need the weekly chart to start cooperating. What do I mean by cooperation? We need to see the green on top of the orange on top of the red, and then we are sitting in a much more favorable environment, momentum-wise, trend-wise, than when we're sitting right now. If that happens, I think that the markets start showing increasing signs of positivity. But we don't want to predict, okay? We want to react. So let's keep an eye on the triple moving average going forward and see if it shows signs of cooperation with what we're seeing on the longer term monthly in terms of the COPOC. Okay, so that's what I wanted to show you today. I wanted to show you just the sort of the next degree of US 2000 analysis, and I wanted to combine that with the triple moving average. If there's any questions, please go ahead and type those in now. Any questions, go ahead and type those in. Please remember on Friday, we're going to do a live trade on a live account. Everyone is certainly invited. If you'd like to participate, just click on that link and you will be forwarded an email with all the details. All right, nothing coming through. So let us wrap up here. And it is Wednesday. So if you join me for the Crypto Minute, that is going to come up next. Thank you very much, guys.